I'm 33 and I actually started investing when I was 23, about 10 years ago now. But I want to unpack in this video what I wish I knew when I started at day zero. Over the last 10 years, I've made many mistakes, many problems are basically created for myself. And I think it's wise to go over them, reflect on them as a learning point for myself, but also for you guys as well. When it comes to finance though, a lot of it revolves around time. And if you make a big mistake, probably means one thing: you're going to lose some money. So let me know in the comments if you've had any of these issues, or if you think that's something that you can add to the comment section in terms of what you've done, because this is my list, my own personal list. I have not lost a lot of money via leverage. I've not done some really, really stupid things, but when you add them all up, all 17 of them, it makes sense. So the first thing here is this stuff. We're going to represent this as money. Over time, it depreciates. You do not realize or understand that saving your money is a problem. So this one, number one, is you do not understand how much money depreciates, right? Saving in the bank, low interest rates, usually a lot lower than inflation rates or whatever, is somewhat of a problem. So when you look at this, right, and you think of the obvious, your money starts to just vanish, and you don't realize it because the spending power of everything else is changing, right? When you do your weekly shopping, for example, it is a lot more. If you are holding it in a bank current account and you're earning like 0.25% interest on that, lovely. You're not getting any value from that. And that is where the problem lies. Now, it will go a lot deeper, this video, in terms of investments and stuff, but when I think about my early self, when I was in the Air Force a long time ago, I'd be making decent money. I'd not be spending it because I was either A, in training, B, traveling the world, or 3, I had nothing to spend it on because all my outgoings have gone and I was just accumulating money, right? If you want a full video on how I invested, let me know. But that was the reason why I started, because I had money to do anything with, and I started reading books. But now when you look at it 5-10 years later, it makes sense. When you are trying to save money for something, it's like, wow, what have we went through as a generation in this early period of, the millennial kind of boom? Is we've had recessions, we've had financial crashes, we've had obviously coronavirus led to quantitative easing, due to then now problems equal inflation. We've lived it all, realistically, in a very, very short period of time, especially in that 10-year investment period where it's pretty crazy. Now, the obvious one going on to number 2 is, well, invest as much as you can while you're younger. Now, yes, I have done this, but nowhere near as much as I should have. Realistically, when I think about all the money that I've wasted or chucked away due to bad decision making, which you will find out what I've done, I should have invested elsewhere. I should have invested in the slower kind of vehicles of wealth, such as the index funds, which, as I say, I will come on to, makes more sense, because when you're investing younger, you've got time to overcome these mistakes, which is relatively good. But when you're older, it may be too late. Sorry. If you're only getting a certain amount of percentage yield on certain monies or return or whatever, yeah, you're going to run out of time. You need to allow that compound effect to go. So what I would say is invest more when you're young and understand the element of it, and then get into the groove of it. Because once you start seeing that compound effect, which I am seeing in a lot of my things, it's relatively good. Problem is, if you're starting at 55, 60 years old, you should be getting ready for low risk. You should be getting ready for retirement. So for me, as an individual, yes, I wish I invested a lot more at 23 than I did at 33, for example. But at the end of the day, I've got time to overcome that. Not everyone does, which is huge. Going back to the trusty old pocket notebooks and the old sticky pad notes and stuff, imagine that as a load of money. One thing that I often preach in terms of educational courses and stuff like that, in terms of teachings, is have an emergency fund first, right? I openly say this when people come into learning crypto, for example. There's a link below if you're interested. People do come in and go, right, I want to invest. Cool, let's go. How much have you got? Not a lot. Okay, why? Because I don't. People need to understand that having an emergency fund is absolutely fundamentally You need to have it, because talk about disruption at the intro of this video. If you have to, say, take a couple of thousand out because your cars blew up, you don't want to disrupt it. Have at least 6 months worth of money laying around. I know it's a lot, but if you're an investor, you need to invest, and you need to keep investing to grow your capital and grow your growth. If that ever makes sense, right? When people start dipping out of it because, the other half needs to do this because a finger's fallen off, or, your car's blown up, or medical care, whatever it may be, whatever randomness, right? Or your bloody boiler's blown up. Taking out of your investments is, no, you shouldn't do that, because that disrupts it. Have an emergency fund first. Get rid of all your high interest debt. Get rid of all your loans and credit, whatever it may be. And the simple rule is, have an emergency fund, and then ultimately just divide up your salaries. Simple as that, right? Just get a spreadsheet, write down all your outgoings, put money aside for investing, and just stick to that, and just keep the flow going, because then you won't have to worry. Even if you can add to your capital's there and you can add to your emergency fund, sweet. But if you can have your investments, literally leave them alone, even better. So I mentioned before, invest as much as you can young, and invest in something obvious. The S&P 500, for example, is a slow wealth vehicle that does over time 10 to 12% on average over the last 5 years is what it creates in capital wealth. Obviously, there's little discrepancies, and if you can handle those rough patches with your emergency fund, and you can keep dollar cost averaging, putting a direct debit into a trading account or an investment account, whatever it may be, brokerage if you're in the US, at the end of the day, that will return, because you won't notice it going out your bank. I know that sounds dumb, but if you've got, say, £100 going out every single month or every single week, whatever it may be, into that fund, and it's just continuously growing, you will grow wealth, right? Because you don't have to touch it. You don't have to worry about it. It's working for you. And if your emergency fund is sitting there, sweet, you can use that if anything goes wrong. Now, it's simple. Returns are not future proof. Obviously, past performance doesn't indicate future results. But on the obvious, most people over the last 20 years who have invested in the S&P 500 have not lost any money. Unless you panic sell, unless you do something silly because you don't have an emergency fund or something in your life change, or you've just fallen out of love with investing. It is a way of life at the end of the day. Now, one thing for me that was a bit of a problem, certainly growing up and going through those kind of younger years, was I was working full-time in crypto and I was looking for the quick riches, right? They don't exist, funny enough. They do in some cases. Some people get lucky. You always see it on social media. A lot of it is ultimately fake, so be mindful of that. Don't look for the quick returns. Don't look for like the stupid emerging market funds or the cryptocurrency assets or the stupid Forex trade on the high leverage unregulated accounts. All this kind of stuff you need to stop and focus on the simple and allow time to happen, because once that time thing comes in and you're growing wealth in the correct way, less chances of losing money, and more importantly, you are not going to get sucked into some stupid Ponzi scheme or a scam or a multi-level marketing bullshit scheme that could lose your money. Yes, we've all been there. We've all been sucked in by for example, a cryptocurrency example is mining, right? You can get sucked into a thing. Oh, I'm mining Bitcoin. I'm earning 4% per day. But you get the idea, right? People get very upset when you say nothing about when you say stuff about that. Look at what's imploded in the cryptocurrency market, such as Celsius and all these high yield platforms, which I will come on to in a bit. But yeah, stop looking for the quick rich. And to go with playing the long game, dividend stocks. I wish I knew more about dividend stocks back 10 years ago, right? I wish I knew. I, at the minute, go for quality stocks. I don't have a lot in them at the moment. I have some in my general investing account, but nothing crazy. But basically, dividend stocks, high quality assets that return a good investment on their dividend for shareholders, but more importantly, they grow them. If you can find a solid stock that's been around for a while that you think is never going to go away, paying you a normal yield that's relatively good, but it's growing every single time, it's going to give you a yield on cost basis, which is going to grow. Basically, if you bought stock, say 10 years ago, and you bought at a certain price, that dividend yield's grown to a certain amount, you are going to get a very nice cost on basis yield. Therefore, passive income and that compound effect will happen. Many people do this. Look at Warren Buffett as an example. Buying what he's bought, you will see the growth in the compound there. Google it. There's a lot of information on this. You just need to find and stick with the quality stocks, leave it 10 years, keep adding to it, good solid assets. Yeah, simple really. Now going into a more crypto-y sort of vibe. I wish I kept my Bitcoin versus altcoins. Simple as that. I first invested in Bitcoin in 2016 at the good old price of about $700, $800 per coin. And I had quite a lot. I'm not going to reveal how many I had. Certainly in 2017 when the whole ICO boom happened, I had a lot of Bitcoin laying around. It was a lot. It makes me cry sometimes because I look at how much I could have had. And I invested a lot more in altcoins when I shouldn't have. Even today, even now, I regret some of my decisions I made even a year ago. I've talked about it. FTX crash, the market lows. I should have bought more Bitcoin. I didn't. I bought more altcoins because I'm an idiot, right? It's just the way it is. Yeah, an obvious one. To follow on with Bitcoin versus altcoins, I wish back in the early days I understood more about dominance. I've understood dominance for a few years, but I wish at the start I knew more about it. I wish I knew when to jump out of my altcoins into Bitcoin, hold my Bitcoin into altcoins and all that kind of stuff, right? You could have played the cycles much better. That can go on to market cycles and how dominance rotates around very, very efficiently and very, very quickly at certain points. If you have high dominance in Bitcoin, you realistically should be remaining in Bitcoin until it flips over. And then when it starts going down, rotate into altcoins because they're starting to go up, right? Likewise, if dominance is low, and altcoins have had a massive run, should maybe move it into Bitcoin. That's kind of the game, right? I wish I knew that a lot earlier. One that is somewhat controversial, and even though I have participated, I often say this to people, don't participate in pre-sale, especially ones with high dilution values, because the shit. Simple, right? Reason being, dilution, emissions, problems. Why is it a problem? Because you invest, you get a really good price, you've got a cliff, you can't sell. But VCs can sell sometimes and they sell on you and you get wrecked. Even as a public investor, you get wrecked. I tell people all the time, do not buy them because they're going to be massive emissions. And unless you get a solid entry and you're willing to wait, that's fine. But if not, you're going to get hurt. So try and avoid the pre-sales. I think in the crypto market especially, we're going to see somewhat of a dot-com bubble-ish sort of vibe where we're going to see many, many assets just fall by the wayside. That is where the problems are. There's currently 2.4 million cryptocurrency assets out there. This is bonkers, by the way. There's going to be a call. Now, again, we talk about investing, but ultimately invest in fewer assets and have more of them and understand the fundamentals more. Basically, have less assets. I know many people that come, as I say, into my Patreon or into learning crypto, and they often go on Discord and go, well, how many should you have? And some people go, well, I've got 82. And you think to yourself, how do you keep up? 82 assets, 100 assets, whatever it may be. I hate having no more than 7 or 8 cryptocurrency assets. My head cannot cope with it. Same with the miners, same with the funds. Why have loads of different funds when you can have one big one? You know, why would you have like 12 miners when you can have 4 or 5? You know, at the end of the day, if they all follow the market, cool. But ultimately, if you start missing things like ATMs or if you miss obvious failures in products, you're going to find, well, why is that crash 40%? Oh, that was obvious. You know, you got to start looking at what you're, investing with at all times and always stick to them. So when we talk about investments, we also talk about passive income, right? In crypto, so also in the stock market as well, that you can apply this high passive income yield. So in cryptocurrency, what was obvious was Luna. It had a thing called UST. It was about 19-20% return of investment sort of vibe every single day. So 20% per year on your money given to you every single day. Yeah, it was pretty crazy. And that was one big mistake that I made. Certainly when we look at the market and we look at what's happening, those do not exist. So again, if it's too good to be true, probably is. Ignore the noise of investments. When I look on my X account and when I go to the For You page, it's absolute bollocks. It really is. It's always people moaning, whinging about their own investments. Like, if you join in certain groups, you always have someone's opinion. My opinion matters to some people. My opinion doesn't matter to some people. If you get footed out of your bags or your investments, whatever it may be, it's down to you. Do your own analysis. Do your own research. Do not listen to other people. That may make you sell. Now, an obvious one would be to take more profits and enjoy life. Now, even though I said don't disrupt the flow of investing, but you can divide it. Simple, right? You could have long-term investment accounts where you are putting money in, growing it wealth. You can have more short-term, more growth, cyclical stuff where you may be more aggressive with taking profits, where you can enjoy life, you can enjoy things, whether that is cryptocurrency, whether that's tech stocks, whether that's Bitcoin mining, whatever it may be. Simple, right? Take more money out of the market, enjoy life, and utilize that element as a reward. Might as well. Now, this one's kind of predominantly for me, but also this may relate to you if you're on X or whatever, or even YouTube itself, is stop trying to copy other people, stop trying to get views, stop trying to do silly things, right? I often find myself looking at YouTube and it's all the same content and I hate it. I want to do content that I want to do now. And you may be the same. You may well wanting to copy someone on X because they made a lot of money on a meme coin, or, you know, they bought something stupid and then made loads of money. Don't get dazzled by them weird ass screenshots and lights, because you may well find that yourself that you get a bit distorted and you totally fail because you've forgotten your risk management parameters, or something as silly as a stop loss, right? Because you think you're going to make a lot of money. It's the exact same with content creation. You may well want to copy someone, or you think it's amazing, but their goals, their setups, their routine may be totally different. Now, it sounds kind of obvious, but this is a good one as well. Stop flip-flopping between strategies and basically how you invest. Remain consistent, because this is something that I've failed with massively over the last decade at least, is changing what I do, right? You may well look at certain factors or certain things and change it completely, and then ultimately the original will work and the new one doesn't, and you've missed out massively. So if you're investing by a certain strategy or you're looking at certain technicals, stick with it. If it works, it works. It'll always work. There will be time periods where things won't work. There'll be time periods where you'll lose money. There'll be time periods where everything that you look at turns to shit. The cryptocurrency market, for example, right now, very hard to navigate, but the simple principles remain true. Stick with it. Have a routine. This is one of the most obvious cheat codes ever. If you're working full time, I know I appreciate that I work in the space full time. Even though I'm very busy, I still have a routine. That routine is very much a part of why I think the way I think and how I do what I do. If you have a job, have a routine where you can check your investments every single day without fail. You can do your homework, whatever it may be. If you don't have a routine and it all goes to shit, you're going to miss out on a lot of things, because my personal belief is investing is a way of life. You know, managing money is a way of like how you grow as a person as well. Problem is, if you fail to do that management, that cleaning, it's like a garden at winter. If you fail to do the basics, you're going to have a bigger job at a later date. So make sure you do that. And the final thing that I wish I knew realistically was to have a plan and set goals, simple goals, because you need to have something to strive for. It's like a fitness journey. You want to lose so much weight, or you want to gain so much weight. Have a plan, have a routine, make it happen, right? Same in investing, right? If you are looking to dollar cost average, say, X amount of dollars, or say $12,000 over the course of the next 2 years, you should divide that up over 24 months and go, right, can I physically do this? Can I actually do this? Do I have an emergency fund? Can I physically afford to put that much money in? And what will my return on investment be? What would happen in 20 years' time if I continue to do that? You will start to find parameters of a plan, a compounded plan where things will make obvious sense. If you don't have a plan or goal set, you're probably going to lose interest very quickly. A very simple video talking about some of the stuff that I think are very, very prominent in why I've lost money, continue to lose money in some cases, and more importantly, how you can actually improve as an investor. However, there's a video floating around my head very, very soon that could well help you in terms of profit taking too.